students. Good morning everyone. Now it's time for your accounts class, and from your second book, Management Accounting, the chapter Ratio Analysis. My today's topic, Profitability Ratio. From the name it is clear, if you want to know about the firm's profitability, okay, then which ratio required? Profitability ratio. Okay. In my previous videos, I discussed with you the meaning of ratios, accounting ratios, then about the liquidity ratio, application of liquidity ratio, solvency ratio, and activity ratio. My today's topic, understanding the meaning and application of profitability ratio. For this, see key terms. Number one key term, indirect expenses. First of all, direct expenses, the cost totally on your production part, like the raw material, labor. And when we are talking about the indirect expenses, the expenditure on overall business, okay, overall operations of the business, like rent, utilities, employee wages, auto parts, office supplies, transporting auto parts, legal fees, insurance. Administrative expenses, like the salaries of senior executives and cost associated with the journal services, like such as the accounting and information technology IT, are example of administrative expenses, like the expenditure totally on your administration part. Okay. Administrative expenses are the expenses an organization incurs on directly tied to a specific function, such as the manufacturing, production. Okay. So the next, selling and distribution expenses. Selling and distribution, like shipping. Number of companies providing the shipping services, like the Shipping Corporation of India, Shreyas Shipping Company, Global Offshore Services, World Shipping. So selling expenses are the costs associated with the distributing, marketing and selling a product or services. When you just incur the huge cost for selling part, how to sell the goods. Okay, for this you need advertisements, shipping. So these such expenditures comes under the selling and distribution expenses. Now the profitability ratio. Under profitability ratio, how many ratios? 1, 2, 3, 4, 5, 6, 7 ratios. Okay. Number 1, gross profit ratio. Number 2, net profit ratio. Number 1, gross profit ratio. You know the difference between the net and gross profit very well. The gross profit, here you not excluded. You not excluded here the indirect expenses, just direct expenses here excluded. And in net profit, you excluded all the indirect expenses also. Operating ratio, operating profit ratio, earning per share, price earning ratio, and return on investment, which is also known as ROI. So International Business Machines Corporation, you know very well, IBM company. Profitability ratio of this company, see, in 2019, 18, 17, 3 years data. Return on sales, gross profit margin of 3 years, see the trend, increasing trend. Previously 45.78, then 46, then 47, increasing trend. Operating profits, in operating profit, decreasing trend. In net profit, increasing return. So return on investment, return on equity and assets, see here on equity, firstly 32, then increase, then decrease as compared to 2018. And return on assets, like previously 4, then increased, then again decreased. This one is the full-fledged trend of 3 years of IBM company. So with the help of these type of ratio, you just find out the position of the company very well. So gross profit ratio. For example, if a company had rupees 10,000 in revenue and rupees 4,000 in cost of goods sold, the gross profit would be 6,000. See बच्चे, so in this case, total revenue 10,000, but the production cost here 4,000 deducted from the 10,000 and the 6,000 totally your gross profit. Gross profit margin is a ratio that indicates the performance of a company's sales and production. This ratio made by accounting for the cost of goods sold, which includes all costs generated to produce or provide your product or services and your total revenue. So in case of gross profit, you just consider which thing? Your direct expenses, your cost of production. How to compute the gross profit sharing ratio? So gross profit ratio here is gross profit divided by net revenue from operation multiply 100. For this you need net revenue from operation. How to compute net revenue? Then revenue from operation minus returns. Your sales return deducted when from the revenue from operation, then it is to be considered as net revenue. Okay, just like in case of net purchases, that sales are same way, deduct the returns, sales returns. Gross profit, net revenue from operation minus the cost of revenue from operation or cost of goods sold. Then with you the gross profit. Cost of revenue from operation. How to compute cost? Here what use cost? Then the cost of material consumed plus direct expenses minus any change in inventory of finished goods, work in progress and stock in trade. So these things required to find out the gross profit ratio. Practical problem. See, from the following information pertaining to two companies for the year ending March 31st, 2017, find out which company is doing better. So here two companies, Band Limited and Box Limited. Revenue from operation of both the companies, see 20 lakh 80,000, 30 lakh 15,000. Sales returns 80,000, 15,000. Gross profit 4 lakh and 5 lakh. Solution: gross profit sharing, gross profit ratio. So here two companies, one by one. Firstly, see the first company, Band Limited. Apply the formula gross profit divided by net revenue from operation multiply 100. So with you, firstly check out this company revenue from operation 20 lakh 80,000. Okay, and how to find out net, because here returns also given. So sales return minus 80,000, with you 20 lakh total net revenue. Okay, then 4 lakh gross profit already given to you. Applied it in the formula. 4 lakh divided by 20 lakh multiply 100, 20%. This company's profit, gross profit ratio 20%. Okay, now the next Box Limited. In the same way, just see 30 lakh 15,000 minus the return. 30 lakh is the exact net revenue. Then 5 lakh is the gross profit, 16.67. So compare both profits. Which company's profits more? Here the first company. It is interesting to see that now the gross profit of Box Limited is more than the gross profit of Band Limited. Yet the gross profit ratio has decreased to 16.67. This shows that the production efficiency of the Band Limited is better than the Box Limited. So see bache, compare it. This company's profit more gross profit and Band company's profit less, but still the gross profit ratio of this company Band Limited more. The reason only here, this company put it the efforts in the right way. Okay, Now the next portion, net profit ratio. So net profit ratio, how to compute net profit? Gross profit add other income minus indirect expenses. So here just exclude indirect expenses. And the ratio, net profit after tax divided by net revenue from operation multiply 100. Calculate net profit ratio of Altos Limited for the 2 years ending 31st March 2016 and 17. So 2 years data of Altos company with you, 2016 and 17. Total revenue from operation in 16, so 25 lakh, and in 17 34 lakh. Sales return 25,000 and 40,000 of 2 years, and net profit 8 lakh and 9 lakh. So here the question to find out the net profit ratio. Apply the formula. You know the formula, net profit divided by net revenue from operation. First of all, how to find out net revenue from operation? Total revenue from operation minus sales. So 2 years data given, 2016 see 25 lakh less 25,000 return, 24 lakh 75,000 here, 2017 34 lakh minus 40,000 return, 33 lakh 60,000. After this, see 2016 8 lakh, here net profit already given in the statement 8 lakh and 9 lakh, and then you computed the net revenue 2 lakh 24 lakh 75,000 and 33 lakh 60,000 multiply 100. So see both here results in 2016 32.32% net profit ratio, but in 2017 decline, now 26.78%. So interpretation, although the net profit has increased by rupees 1 lakh, but this is misleading. The real position is that the operational efficiency of the company has decreased by 5.54%. So see 2016 net profit less, in 2017 9 lakh, but here compare why here net profit ratio less, just because of again the same problem, the operational efficiency. Okay, efficiently worked in 2016 as compared to 2017. Now the next ratio, earning per share. From the name it is clear, earning per share means what is the earning per share? Per share means this unit available, okay, or the second name price earning ratio. For example, if the sector's average price earning is equal to 50, so here the standard set 15, stock A and stock B available. Stock A's price earning 15, stock B is 30. So stock A is cheaper. However, the stock B has a higher ratio than the both its competitors and sector. So stock A's price 15 cheaper, okay, because the B's 30 price more than the standard price and stock A also. So earning per share means when the shareholder wants to know about the market value of share, then with the help of this ratio you just find out the answer. Why is price earning ratio required? So price earning ratio is computed to know the expectations of the shareholder from the market value of the shares. This ratio helps the prospective shareholder to make the decision regarding the purchase of shares of a particular company. Like suppose you are not yet the shareholder of the company, but you want to purchase the shares of the company. For this, you firstly check out the price earning ratio of the company. If satisfactory, then you are ready to invest in the money, otherwise no. Okay, for this purpose you need price earning ratio. So what is the formula? Price earning ratio is equal to market value of an equity shares divided by earning per share. Applicability of formula on real companies market situation, like here the Bharat Heavy Electricals Limited. See the current data of this company market situation. Market value of share as on 7th August 2020 rupees 35.70. Earning per share of this company rupees 3.32. So what is the accounting entry here? Divide the market price of share by earning per share to find out the price earning ratio. Apply the formula. Market value of an equity share divided by earning per share. So here market value 35.70 divided by 3.32. So here this company price earning ratio 10.75. Next practical problem. From the following information, calculate following ratios up to decimal places. Earning per share, price earning ratio, return on investment. So with you the information net profit after interest and tax, then net fixed assets given, net non-current investments given, equity share capital 15%, preference share capital, and reserves and surpluses, revenue from operation 10%, debenture, working capital. Now I'm going to discuss with you the three ratios of profitability with the help of this statement. See, earning per share, net profit after tax, and preference dividend divided by number of equity shares. So first of all, check out the net profit after tax and preference dividend. For this, see, net profit after tax and interest 2,40,000. Put the value here 2,40,000. Deduct the preference dividend. So check out the preference dividend. 15% preference dividend, find out quickly. So here 15% dividend means 1 lakh, 15% here minus 15,000 divided by number of equity shares. Check out the equity shares available in the statement. Number of equity shares, if the 10 face value, divide 5 lakh divided by 10. So with you the 50,000 shares units means available. So here 2,40,000 minus 15,000 divided by 50,000 units, rupees 4.5 earning per share. Here the answer. Okay. Dividend on preference 15%. How to compute 15,000? With just apply it on the full value. With you now 15,000 dividend. Now the next portion, price earning ratio. Market value of an equity share, earning per share. Now just calculate it, 4.5 earning per share, and find out the market value per share. Like here in this statement 40 rupees. So 40 divided by 4.5. 8.89 times is the price earning ratio of this company. Okay. Now the next portion, return on investment, means when you want to know about the returns on the investment. Firstly you invested the money, then you want the results. Return, how much return? So it shows the relation between the profit and capital employed. You firstly employ the capital, then you want profits. How to compute the capital employed? Capital employed is equal to shareholder funds plus long-term debts. Here firstly the owners invested, then sometime the owner borrowed the money from the outsider, banks or any lender, minus non-trade investments. shareholder funds including share capital, reserve and surpluses, and undistributed balance of profits. This one is the formula. So net profit before interest and taxes means here before considered. So for this, add the interest and tax. 2,40,000 in the statement, net profit given, add 1,60,000 interest and tax 40,000, and divide the capital employed 12 lakh, multiply 100. So with U 36.67 is the return on investment. Okay, and capital employed, equity shares, reserve, surpluses, preference, dividend, and with U the 12 lakh is the capital employed, means the owner here invested 12 lakh. Now the next ratio, operating profit ratio. So in operating profit ratio, like one example here, lottery tickets. Your expense of lottery here 3,000 and lottery income 50,000. Then the net profit will be after taking into account both the lottery income as well as the lottery expenses on lottery tickets. If we eliminate these two items out of the net profit, then we will get the net operating profit, because here we just consider operating, means activities of the business operations. So lottery price and lottery expenses, not your day-to-day operation work. Okay, so for this, eliminate the lottery income will be deducted and the expenses on lottery tickets will be added to the net profit. So if previously you deducted the expenses or added the lottery income, then reciprocal the entry. Okay, add the expenses and deduct the income, because this one is not related to your day-to-day operations. What is the formula? Net operating profits divided by net revenue from operation, multiply 100. Okay, so how to find out the net operating profits? Gross profit, add other operating incomes, minus all operating expenses. And how to find out operating expenses? Simply your administrative expenses, selling and distribution expense, considered as operating expenses. For your operation, you paid to the parties, and these all expenses under operating expenses. Operating ratio, cost of revenue from operation, add operating expenses divided by net revenue from operation, multiply 100. So see, with the practical problem, calculate the operating profits ratio from the following data. So with you, opening inventory, purchases, sales, closing inventory, administrative expenses, selling expenses, dividend on shares, loss by theft, sales return, insurance claim. So operating profit ratio, apply the amount. So for this, you need, according to formula, operating profits. First of all, for this, see how to compute operating profits. Revenue from operation minus opening inventory, add purchases, add administrative expenses, add selling expenses, deduct closing stock. So first of all, see the opening inventory 50,000. So record here 50,000. Then purchases 5 lakh. Then your administrative expenses, selling expenses 25,000 and 60,000 minus 75,000 closing stock. So with you 1,75,000, the amount of operating profits. Now it's time to find out the revenue from operations, sales minus sales return. With you, the revenue from operation, that is, see the sales, gross sales given, yes, 7,50,000. Record return also 15,000, deduct 7,35,000 is the revenue from operation. So 1,35,000 divided by 7,35,000, multiply 100. So 23.81% is the operating profit ratio. of the company. So these all are the ratios of profitability today I discussed with you. Now it's time for homework questions. Solve the practical problems 81 till 105 along with the illustration related to the profitability topic, and must watch the YouTube videos of profitability ratio for more better understanding of the topic. Thank you so much, students.